Imagine this, it's the year 2000. Two guys walk into a giant corporate boardroom in Dallas, Texas. They're nervous, sweating actually, because on the other side of that glass table sits the CEO of the most powerful entertainment company in America, a $6 billion giant, 9,000 stores across the world, and these two guys want to sell their little startup to him for $50 million. He listens, he nods, and then he says no. Today that startup is worth over $400 billion, and that company with 9,000 stores doesn't exist anymore. Okay, so let's go back to 1997. Two guys, Reed Hastings and Mark Randolph, start a company called Netflix. At this point, Netflix isn't what you know today. It's a DVD rental service. By mail, you go online, pick a movie, and they post it to your house. No due dates, no late fees. Now here's the thing about late fees. Blockbuster was making $800 million a year from them. That's not a side revenue stream. That's almost 20% of their total income. Late fees were basically Blockbuster's business model, and Netflix was quietly destroying it. But in 2000, Netflix isn't winning yet. They're losing money every single month. The dot-com crash has just happened. Investors are spooked. And Hastings and Randolph are desperate, so they fly to Dallas. They walk into Blockbuster's headquarters, and they ask to be bought out for $50 million. The meeting is on the 27th floor of the Renaissance Tower. Hastings later wrote about this moment. He looked around the room and whispered to Randolph, "Blockbuster is 1,000 times our size." They sat down at a massive glass table, made their pitch. "Buy Netflix for $50 million. We'll run Blockbuster.com for you. Online rentals, your brand, our technology." Antioco listened. He nodded, then he said no. Now here's what most people miss. Antioco wasn't stupid. He was actually considered one of the best retail turnaround CEOs in America. He'd already saved two major chains from bankruptcy before Blockbuster. And at that moment in 2000, his reasoning made sense. Netflix had 300,000 subscribers. Blockbuster had 60 million customers. Netflix was losing money. Blockbuster was printing it. Antioco saw Netflix as a niche product, something for tech-savvy early adopters, not a real threat to Blockbuster's core business. He publicly said the dot-com hysteria was overblown, and honestly, at that exact moment in time, he wasn't wrong. This is actually a classic case of something called the innovator's dilemma. It's a concept from Harvard Business School professor Clayton Christensen. The idea is simple. Successful companies get disrupted not because they're incompetent, but because they're too good at serving their existing customers. Blockbuster's existing customers loved the store experience. Late fees were annoying, but people still showed up. Changing that model would mean cannibalizing their own revenue, upsetting franchisees, angering shareholders. So they didn't move, and Netflix kept growing quietly in the background. This is how disruption actually works. It doesn't announce itself, it just keeps getting better one subscriber at a time. To be fair, Blockbuster wasn't completely asleep. In 2004, 4 years after rejecting Netflix, they finally launched their own DVD by mail service, called Blockbuster Online. And here's the thing, it was actually good. By 2006, Blockbuster launched Total Access. You could rent DVDs online and return them to physical stores, something Netflix couldn't do. Netflix stock dropped 10% when Total Access launched. Hastings later admitted they were genuinely scared. Blockbuster had a real competitive moat here, physical stores as a distribution advantage. It could have worked. But then something went wrong. Activist investor Carl Icahn started pressuring the board. Total Access was expensive to run. It was hurting short-term profits. So the board made a decision. They fired the CEO who built the strategy, replaced him with Jim Keyes. And Keyes made one of the most infamous statements in business history. He said in 2008, "I don't see Netflix as a competitor." That same year, Netflix had 8 million subscribers and was building the technology for streaming. Blockbuster went back to focusing on retail stores. They eliminated the strategy that was actually working to protect margins in a model that was already dying. By 2010, it was over. Blockbuster filed for Chapter 11 bankruptcy with nearly $1 billion in debt. The same company that turned down Netflix for $50 million had collapsed under $1 billion of its own weight. Dish Network bought the scraps for $320 million. At its peak, Blockbuster had been worth $6 billion. It was now worth less than Netflix had been asking for 10 years earlier. So what's the actual lesson here? It's not Blockbuster was dumb, because they weren't. The lesson is about switching costs and legacy revenue protection. Every decision Blockbuster made sense in isolation. Don't buy a money-losing startup, logical. Don't destroy your late fee revenue, logical. Focus on what's working, logical. But logic built around a dying model is just a slower way to fail. Netflix didn't beat Blockbuster by being smarter. They beat them by being willing to lose money now. to build recurring revenue that scales forever. That's the real difference between a legacy business and a scalable one. Blockbuster was optimizing a model. Netflix was building a machine, and in the end, the machine always wins. If this changed how you think about disruption and business strategy, subscribe.